Welcome to this session on navigating the fiscal squeeze. I'm Stephanie Flanders, I'm Head of Economics and Government at Bloomberg, and I don't think it's any news to anybody here or anybody watching that the global public debt is extremely high. And if you look at the latest IMF numbers, we're looking at a stock of global debt that is now around 93% of global domestic product, but could be 100% by 2030, which is a lot higher, 10 percentage points higher than it was before the pandemic, and of course is also a step higher, we believe, since the global financial crisis. You know, if that wasn't enough, we're obviously looking at the cost of that debt getting more expensive for governments, just as some pretty big demands are making themselves felt, not, from politics, a lot of demands as ever from right and left, but also the demands of these very concrete challenges that countries face, from climate change, the climate transition, aging, health. So this is a major issue for countries around the world, and I think we might potentially talk as much about developing economies in this session as we talk about the US. Maybe it'll be almost the only session at Davos where we try and have some parity between the two. But we do have a very kind of wide range of experience and perspective on this as we think for this session about not just the challenge, but I hope the impact on business, on government, and crucially the solutions, the paths potentially that these eminent panelists see through this multi-headed challenge. So starting from my left, Ali Ahmed Al-Kuwari, who is the Minister of Finance for the state of Qatar, Gita Gopinath, previously Chief Economist for the IMF, now First Deputy Managing Director of the IMF, Mthuli, Ncube, Minister of Finance for Economic Development and Investment Promotion, Finance, Economic Development and Investment Promotion for Zimbabwe, Kimberly Klausing, who is a chair in tax law and policy at UCLA School of Law, and David Schwimmer, the Chief Executive of the London Stock Exchange Group. So as you can see, a very broad range. Gita Gopinath, I should start with you because you have the bird's eye perspective. You were just commenting, the IMF does a lot of surveillance, and the fiscal monitor that's produced by the IMF every year and the various updates, I was quoting some of the numbers there. You have a very clear sense of this problem coming down the track or already with us. You've talked about the need for a fiscal pivot, without taking up all the time, because I know there's a lot of policy to talk about, but very briefly, what does that involve? What do you see as the path forward? What does the IMF see?
Yes, so firstly, recognizing the scale of the problem is very important. And in one line, I would say that it is worse than you think. We're at $100 trillion in terms of global public debt now, and we are headed towards, as you mentioned, 100% of GDP public debt by 2030. That's 5 years from now. But if you look at our, in general, everybody's debt projections, there has tended to be an optimism bias. And usually the 5-year out public debt to GDP tends to be 10 percentage points higher than what most institutions tend to project. And the reason for that is two. One, it is very hard to predict an event like a pandemic or a great financial crisis, and that will happen. You have shocks that cause governments to spend more. But the other thing is, governments have poor follow-through in terms of when they make promises on the fiscal front, being able to deliver on that. So that's one reason why it's worse than you think. Another reason why it's worse than you think, as you mentioned, is the many areas where more spending is needed. And if you add that up in terms of spending on climate, the climate transition, aging populations, digitization, and so on, that's an additional 7% of global GDP that it would take for governments to be spending on. So all of this makes it really substantial. So why did I talked about the need for a strategic pivot, and the reason I say that is because I feel we've all lulled ourselves into a place where we think that is, especially if you're an advanced economy, you really don't need to worry about it because, hey, our debt levels have been going up and nothing dramatic has happened. And I think that's changed. I would say over the last couple of years, that's no longer the case. We are no more in a world where you have a global savings glut like we used to have in the past. Interest rates are going up, and that is an important concern. And secondly, central banks are not doing large-scale government bond purchases. That's not happening. And so you see much more volatility in the interest rates at which even advanced economies borrow. And you see market reactions, including in countries like France, where you see the yields moving up and down. So that's the reason to step back and say it's worse than you think. You need an absolute pivot because the problem is this is not business as usual. But the approach you're going to have to take is one that is growth friendly. And I'm not going to go into this, as you said, I want to take up all the time, which is growth friendly, that has good guardrails for it. And the third G I would put there is grassroots, which is to make sure that civil society comes along with it.
Well, I want to get on to what are some of the answers. We're sort of thinking about what advanced economies should do, but I think there's also clearly a lot of some of the poorest countries facing some very pressing challenges just servicing the debt that they have now, and it's taking up an enormous share of their revenues. And I mean, Minister Ncube, we have people in very different positions in this panel, but if anyone can talk about a fiscal squeeze, it's you. Your country, you have a 10% budget deficit. You don't have access to external financing at the moment, or even you don't even have, Gita Gopinath's not allowed to lend to you at the moment, I don't think.
Absolutely.
So
she'll be fired if she gives me money.
So unless she writes you a check afterwards, I think. But how are you funding that gap, and how does it affect your macroeconomic stability?
It's not very easy to fund the gap. First of all, you just have to do the plain vanilla fiscal discipline, just to deal with minimizing the growth in the primary deficits. By running cash budgets or quasi-cash budgets. That's what we had to do to make sure that we live within our means and we try to minimize borrowing. But also we've tried to be innovative on the revenue front in terms of domestic resource mobilization to create space for additional expenditure. We've been introduced taxes, for example, such as the what you call the intermediate money transfer tax. If you are sending money within Zimbabwe, you will get taxed by on a mobile phone or doing an interbank or whatever transaction, whoever you're paying, you pay a tax for that. SIM taxes to target the health sector, for example. We've got those kind of taxes. We've even got a tax now on fast foods. If you're buying tacos or pizza or something, you pay an extra fee. Just some innovation on domestic resource mobilization is one of the solutions, just to create the space to fund anything fiscally. But it starts with the expenditure side, in my view. Just a simple plain vanilla cash budget or quasi cash budgeting system is the way to go. We have not really fared too well as Africa out of the pandemic. We have seen an increase in debt levels. In 2013, we were at about 30% of GDP, debt to GDP ratios, but now we're sitting at 65%. So that additional debt squeeze in terms of interest burden is putting pressure. We are engaging in debt restructuring. Zimbabwe has got a very difficult debt restructuring exercise, which is also political. So you have to bring all the parties together. I didn't know that I could also be a Minister of Foreign Affairs. I'm learning, how to bring diplomats together, make sure they're all in the room, they're happy. Now I begin to understand the US better versus the UK, the Italians. You have to spend time doing financial diplomacy, get everybody on board to do the debt restructuring, and we're making progress. But
you're getting through and the arrears. How are you addressing that?
We've created a debt arrears platform, which involves getting the creditors all in one room with us, and then creating 3 channels for sets of important reforms: economic reform channel, governance reform channel, and a land reform channel, because Zimbabwe has got the history of the land issues. Again, I've learned to become a Minister of Agriculture, So just being able to restore property rights within that sector is critical for moving forward. And also compensation. We started compensating the farmers who lost their land in 2000, 2001, in the early 2000s. So we're making progress, and we're about to take on a staff-monitored program with the IMF. The mission is coming through in 2 weeks' time. Hopefully then we do a 12 months SMP program, which will then lead to the resolution of the arrears for preferred creditors, which is World Bank, AFDB, and the European Investment Bank. So we're making progress.
Okay, we might be able to talk a bit more about that, because it's obviously been an ongoing problem, and a lot of people are still wondering how you're going to get out of the hole. But if we're going to go for the full extremes of this panel, I would turn to you, Minister Kuwari. No fiscal problem in Qatar, budget surplus, low debt, which obviously means that people come to you wanting to solve their fiscal problems. You've given a lot of diplomatic support to the war-torn countries in your region, most recently Gaza, but also Syria and Lebanon. Do you see yourself as part of a solution or an easing of the fiscal squeeze in those war-torn countries, as well as such a diplomatic support?
Thank you very much. I mean, first of all, I would like to, change the word from, fiscal solution to where we have a fiscal discipline. I think this is how I would like to describe, our fiscal policy in Qatar. And what we have done, we have developed a medium-term fiscal policy framework for the country, looking forward for 20 years with different scenarios of revenue scenarios based on different oil prices and even taxations, and also different scenarios on the spending side. And we decide from now, what's going to happen, in each case, whether it's a surplus or deficit. During the surplus, we save for the deficit years, and even we invest with the Qatar Investment Authority for the future to ensure there is an intergeneration equity for the society going forward. So we've been really very disciplined, in our approach, and as a result, we have managed to reduce our debt. In 2021, which was 78% debt to GDP, now we are at 41%. And as a result, we get upgraded by the 3 rating agencies to a AA from a AA-. So we have been really very, very, very disciplined. In terms of our position, yes, we like to work with our partners, with countries, and we like to work with the multilateral organizations such as IMF and the World Bank. And recently we have developed an initiative with the World Bank, which was a debt swap initiative, which I presented even, and when I attended, the Paris Club meeting back in June, and this is, I think, it's one of the solutions. It's not the solution, but this is really helps, some countries where they have really a struggle and a long-term struggle, to balance their budget, basically to let go some of the debts against a commitment to invest in certain sectors of the economy, mainly education. Our initiative was about education, because we have an initiative by Qatar Foundation. It's called Education Above All, and they are very active worldwide, and we started this initiative, and it seems like it has received so much positive, feedback from other countries who wants to copy the same initiative. But again, going, to the big picture, in terms of the debt issues, I want to say something, I think the fiscal deficit or the fiscal squeeze is a problem nobody wants to speak about, and I think it's thanks for this session. Thanks for you. For raising this issue. But that's
all we want to talk about.
Yeah, it's very important issue, and it's a very important problem, and it's increasing, problem, and it's going to really hit very hard. It's going to be a very big financial crisis, it's going to be a huge impact if we don't do anything about it, today. Because what happens, I think so many people are focusing in the economical growth and creating, very quick wins, and for the economies, especially many governments, they get the credit for that. And the fiscal issues get to be forgotten, and let someone else worry about it at some point in time. I think it's very important that the fiscal, receives an important attention. And the fiscal the fiscal balance has to be complementing the growth. So we should not have a growth at the expense of the fiscal. And this is what we have seen, in so many, even advanced economies, they're doing the same thing. So it's very important that we have a quality growth, for the economy, which does not hinder, the fiscal balance. This is very important and goes hand in hand. And we want the economy to spend in the fiscal, not the other way around. This is one thing. It's very important also, to have prudential policies, for the countries. They have to look how to be disciplined in their view of the revenues and the spend. Taxation policies, yes, you need to have an equitable, taxation policies for all different people in the society, but in the same time, not to hinder growth, for the economies. Multilateral organizations, again, I will go to Gopinath, and, I think very important, they play a very important role. And what they are doing, I must, salute what they are doing, in terms of they don't come with the money and just somebody who needs the money, but they come with the programs, they come up with a monitoring, the surveillance. And it's very important that we look at it from the holistic point of view, for this country. And again, also, I think the other issue that, I think we should do, to help, with the fiscal, with the fiscal issues, really to continue to monitor and also give help, for the countries. But, the problem now today is not only, countries who are struggling with debt and who's going to be struggling for debt, but the problem also, even some advanced economies, I think they have issues, and
well, yes, we might turn to that now, I think.
So I mean,
yeah.
So when we look at it, we should not only look like saying certain countries who have problems with to balance their budget, but I think it's it's a growing problem. The other issue is the debt. Again, so many countries, their debt is linked to the dollar, which is very strong at the moment, and the rates are very high. So they leave very small fiscal space to invest on education, health, and other.
I think, and we will get back to some of that. But Kimberly Klausing, you're sitting in the US. You had raised some warnings before the presidential election for both parties, I think, on the fiscal trajectory. The minister talked about even advanced countries growing on the back of unsustainable fiscal policy, and I can think of at least one quite large one that's been doing that. How much of the fact that the US is on such an unsustainable fiscal path and some of the promises that the new administration has made seem to have destined to make that worse, that's going to inflict a cost on the whole of the world, potentially.
Yes, indeed. And I guess I would echo what Gita said about it being worse than we think. If you look at U.S. deficits to GDP, the CBO forecast, they'll be about 6% of GDP over the coming decade, and debt will climb from about 100% to about 120% of GDP. But all of that assumes several things. One, that the Tax Cuts and Jobs Act expires as it's supposed to at the end of this year, right? But that the number one priority of the Republicans in Congress and President Trump is to extend that. If it's fully extended, that will add another percentage point and a half to deficits as a share of GDP, and so debt will rise accordingly. The other thing it doesn't account for is negative shocks, and there could be negative shocks for unforeseen things, like a pandemic or a national security issue or a recession, and recessions do happen at times, right? But there also can be self-injury with respect to economic growth. And growth is indeed very important for the fiscal situation. We've had very strong growth recently. But imagine, for instance, one engaged in a trade war and raised tariffs on our three closest trading partners substantially. That's going to throw a big wrench into U.S. growth prospects because a lot of our imports are intermediate goods. So this hurts the U.S. manufacturing process, and it hurts our export industries because trading partners will retaliate and because exporters are also importers. Let's say you layer some deportations on top of that and you move away some of the labor force out of the United States. That also hurts growth. So I think those kinds of factors.
I think President Trump would want to emphasize you still get money from those tariffs, though.
You get some money from those tariffs, but I think the tariffs from the first Trump administration, the majority of them went to compensate farmers for retaliation, and there's still only 2% of federal revenue, right? So it's not a lot of revenue, and it's nowhere near the extensions. So I've done some calculations that suggest maybe you'd get, with the full throttle version about $2 trillion over 10 years. The tax cut extensions cost $5 trillion. So that's before we even get to the campaign promises. So I think in the United States, it's very much worse than you think. And so one question to watch in the future is how the markets react to this, right? If they do this sort of Christmas tree extension where they give everybody what they want because they're very narrow margins in Congress, I can imagine that the bond market will have something to say about that. And already we see interest rates reflecting some fiscal risk in the United States. And that, of course, has spillover effects to other countries, as does the strong dollar that we might see coming out of the tariffs as well.
Well, so David Schwimmer, you're sitting in the UK at the London Stock Exchange, obviously one of the countries that has very much had some collateral damage from the increasing cost of finance that the US is kind of exporting to the rest of the world is the UK. I assume you've been advising Chancellor Reeves here and privately in London on how does she get out of this hole?
I think there has to be a focus, of course, on fiscal discipline and on growth. Yeah. And Gita touched on this, Kimberly touched on this. And as the private sector representative on the panel, I'll have to take an optimistic perspective on what is a very challenging situation. And maybe the first point just to make about this, and a number of the panelists have touched on it, there has been a failure of the political leadership to address the topic. And I think there was an enormous missed opportunity after the pandemic. If you think about how governments around the world, especially in the developed countries, funded their economies for 2 years, spent an enormous amount of capital on that. And then after that, there was an opportunity to communicate to the populations, this is not free and there are consequences to that. We never had that discussion, as far as I am aware. I don't know if anyone saw that discussion taking place anywhere. And so I think that's a huge loss and a huge miss and a failure of political leadership. And I'm not a politician. I recognize very difficult role, but a missed opportunity there.
Sorry, if you want to carry on. I just wanted to push back slightly. I mean, I think if you're on the government side, you say, that's all very well, but then every time we try and raise some money and we look at where the money is, you know, the increase in private wealth that's occurred over the last few years, but then they're told they can't possibly tax wealth because all of the great entrepreneurs will leave the country. If they try and raise corporation tax or raise taxes on business, they get enormous pressure from the corporate sector on that. So I guess some of these ministers who are looking for money would say the private sector doesn't make it easy to find.
I did not say it would be easy. And I think one truism is that no one likes to pay higher taxes, but people are expecting services. The demographics, as this group, demographics are challenging. And the interest rates are actually going up, the costs are going up, not to mention the other issues, security, climate, that do need to be addressed. So, as I said, no claim that it's easy, but the fact that the conversation has been seen as a non-starter in the political world, I think is a problem in and of itself. But to come to the potential for growth, to help deal with this situation, and I say help because it's not the entire solution, but I think there is opportunity to improve productivity in a lot of economies. You've seen relatively higher productivity in the US than certainly in Europe. I think there are opportunities with respect to what we're seeing in technology. A lot of hype here and around the world around the benefits of AI. I would say there is substance beneath that hype. And in our own business, where we have implemented some of this technology, we are seeing 50% improvement in terms of some of the functionality. So I just use that as a micro example where there can be benefits for productivity from technology. A lot of discussion around regulation and the notion that regulation can be more pro-growth. I think if the notion of regulation being more pro-growth is put in the context of this particular issue, I think that might change the perspective on it a bit. If it's about dealing with the debt burdens of various economies, then that regulatory perspective might shift a little bit. And I think you can have targeted regulation that still is doing the right thing in terms of protecting consumers or protecting the markets, but also is targeted in the appropriate way that it can be promoting of growth. One other topic I'll just touch on briefly is the appropriate use of the existing resources. A lot of populations have their savings in cash, and they're probably not earning great returns on that cash. And we see this issue in the UK, it's a big issue in Japan, it's a big issue in a number of markets. If we had the financial literacy and support for populations to put a lot of that savings into higher returning instruments, potentially equities.
The London Stock Exchange, for example.
Doesn't have to be in London. We would welcome it, but I think equities present, over the long term, a much better opportunity, and having that kind of capital put to better use in economies on a macro basis could help, as I said earlier, accelerate the growth issue, or accelerate the growth and help address this issue.
Gita Gopinath, I mean, so you're here and we've been talking about the challenges facing a range of countries, but obviously, you know, you have the poorest economies in the world have to pay more than $290 billion in foreign debt in the next few years. They're already spending on average, half of their revenue on servicing what they owe to domestic and foreign creditors. We don't have, I mean, the international community does not seem to have a compelling and reasonably swift approach to helping countries who actually need debt restructuring. I mean, Zambia, 4 years it took, and many people consider it still to be at a high risk of debt difficulties, even though it has had a deal.
So, yes, you're right. You're right that in terms of the public finance of low-income countries, there are several challenges. I want to point out, though, that right now, as we see it, there is more of a liquidity challenge than a solvency challenge in many countries, which means as long as they're able to roll over their debt that's coming due in these next couple of years, and as you said, it's quite substantial. It's about 3 times what it was pre-pandemic. So there is a chunky amount that's coming through in terms of needing refinancing. If that happens, then we're all good. And so it is more of a liquidity challenge at this point than a solvency challenge.
But how is it going to happen in this environment that we're
It has been happening.
about?
So you've actually seen over the last year, you've seen more frontier markets accessing, being able to roll over and being able to raise money. Now, the challenge, of course, is that if interest rates in the US stay higher for longer, the expectation was that we would see more rate cuts this year, but that has changed, then that's going to make it more difficult. Now, to your question of debt restructuring, which is, yes, there are countries that need debt restructuring, and the landscape of creditors is very different than what we had 20 years ago, when it was only the G7 countries. But now we have, China, we have Saudi Arabia, we have India, we have other countries that are not familiar with the whole debt restructuring process that are a part of this. And so there has been progress made. If you'd asked me a year ago, I would be way more frustrated than I am now. I actually do think that there has been concrete improvement, the common framework. We've seen much faster deals being made. I think we've gone much faster, for example, on Ethiopia, which was the most recent case, than if you go back to Chad or go back to Zambia in the past. So the trajectory, the direction of travel has gotten a lot better. But I do want to point out that we still don't have any kind of an automatic mechanism where all of this gets sorted out very quickly, and it does depend on cooperation in the world for this to work. So I'm just going to wait and see how this plays out in the next months.
Just on the cooperation point, and then I promise I'll come back to everyone else, but you had, on the liquidity issue, which is for many countries is the most pressing, you had, at the annual meetings, the institutions had put forward an approach to resolving that issue, a short-term issue you just highlighted. The Biden administration didn't think it was targeted enough, didn't think it was aggressive enough. What are you expecting the incoming Trump administration to think about it?
Actually, we worked very well with the Biden administration, the Treasury particularly, we were working very closely with them on this. This is the three-pillar approach that we have, which is basically, one pillar, which is if countries are serious about undertaking reforms, so that this is not a quick fix, but something that is durable. And then we, as institutions, multilateral institutions, can provide more financing, but also how can we get the private sector to put more money in? Because one of the trends that we have seen over the last couple of decades for emerging and developing countries is that there has been a decline in interest in the region in terms of money going in, right? So we need that has to change too, because there is not a good enough growth story right now there. So that has to be addressed. So this three-pillar approach is something that we are working on. It is basically a way to get countries to grow faster, and everybody is better off, including American businesses, if there is more growth in all parts of the world. So, we've worked very well with all U.S. administrations, and I expect that will be the case with the new administration too.
Interesting theory. So, Minister, we're talking a lot about the sort of the US, what an economist might call the externality that comes from the US sort of exceptional policy at the moment. It's felt very strongly by emerging market economies. How do you feel? Do you worry about the countries that you're engaged with and the region, how the region is affected by if we continue to have a higher cost of finance for countries that are already in difficulty?
If I kind of speak about our region, mainly the Gulf region, we are back to the dollars, and because of our, our economy is based on mainly in the oil and gas, so that's why we are back to the dollars, so we avoid volatility there. And we, as a result, we have to follow, the Fed policies, in this one. And to be honest, our economic structure is different than the US. We don't have the same issues like our inflation. For example, look to Qatar. Our inflation 0.9%, as of November, and the full year we'll finish it with 1% inflation. So we don't have the same issues, but we are obliged to follow, the US Fed policy, and the rates. And this is sometimes, creates a big challenge for us, because especially if we want to support the economy, the private sector, then the interest rates are very high, and that's, does not help us with the growth. So we have to look to other tools to, to support the economy. Now, the new U.S. administration, President Trump, I think, I all agree with Gita, we have to wait for some time to see the outcome. But, I think we have seen President Trump before, it's not the first time. And I believe, I think we are very clear about his policies and, trade and everything. I am a little bit maybe this time more positive or optimistic. I think, maybe things said maybe will not be implemented. I think because it's a different story. He already served, 4 years. He has seen, the outcome of, these policies. So I think, yes, there are already many executive orders have been signed yesterday. But, I think, going forward, I think, especially the issue with China, I think, which is the most important thing, I think we need to worry about. For the world, not only, but for US and China itself, it's very important because this, disputes, it's not helping anyone. My colleague from UCLA, she talked about, about the challenges of these policies and the inflationary pressure it's going to create in the local economy, local US economy, and retaliations, from other parties. But I think it's very important that, these policies becomes, I think the biggest challenge, here, this protectionism, policies have been really very difficult because we have worked very hard, historically to build a rules-based system. And I think challenging this rules-based system now coming, it's going to be, this is actually the biggest issue maybe in the debt is really having a global solution, having a working solution, for all the countries. And this is what we used to happen. Now I think everybody is looking at it differently and saying, this is my issue and worry about it.
But in the meantime, would you consider supporting Syria, for example? You've supported the new government from the beginning. Of
course. I think there is a duty. I think there is a new government in Syria. There is a new leadership. Dictatorship has gone. I think there was with the a big bloodshed happened in the past. So I think the whole world has to support Syria. It's not, I mean, the government, in Syria. I was in Syria last week, and the words and the promises we hear from the new leadership there is very, very promising and very positive. I think they know that they have now a new task, changing from a revolution to a task of building a country, building a government, building an institution. And that task, I think it will need the help of the world. I think the world can avoid Syria going into the bloodshed used to have before.
You talked about the example of education that you've had the support for. Would that be one way that you would be?
Of course. I think, to me, if you ask me what's the single most important things to help needing countries is education. I think if we are to invest in something, to invest in education. Educate people. If you educated people, they will work hard, they will make money, they will prosper, they will grow.
Would you do that without the World Bank and the IMF? We just go in?
No, we need to work together. I think it's very important. See, the World Bank and the IMF, they have a big advantage. They have programs, they have expertise, they have, capacity building, So it's very important, I think, to work. Okay, yes, we have the tools, we have the capitals, but we need to work together. And I think this is very important. This problem is not going to be solved by a single country or by a single, economies. It has to be a joint effort. Everybody has to work, together.
Okay, we have about 10 minutes left, and I know there's smart people in the audience who may have questions, and I don't want to get in trouble for not calling on you. We have very wide-ranging things we could talk about, but yes, if you just wait for the mic and maybe say who you are. Question, not a
Thank you.
speech.
The name is Wale Edu, Minister of Finance, Nigeria. Just as we've heard here that it's a big problem in terms of the U.S. deficit. I think there's a huge problem in terms of the developing countries. Yes, they have low growth. Yes, they are faced with what we are seeing now as a new scenario of rising interest rates. And if it's a liquidity problem, it's like treading water. It's a liquidity problem in the sense that they can just about make the next payment. Apart from the situations of the Zimbabweans, I think that it's except for a few countries that can crowd in private sector investment, it's something that really should be looked at, and a global solution should be had. Let me finish. There should be much more focus on a global solution to the debt problem in the third world, in developing countries. Luckily, in Nigeria, we have had the ability to, under the leadership of the president, claw back 5% of GDP, which gives us a chance to now stabilize the economy, crowd in private sector savings. But the point is this. We need more flexibility, particularly from the IMF. They lent us funds about, 3-4 years ago during COVID, and they set the terms. So next week, we'll pay back $500 million, which normally they should say to us, this $500 million that you've paid, we can see, we're looking at what you're doing, you still need it, take it again. That kind of flexibility is needed in the thinking of these international institutions at this time. Thank you.
Okay, well, we have talked a bit about the liquidity thing, but I think we can come back to it. Yes, just as it's a question, yeah.
Just one quick question. I mean, Japan's debt to GDP is more than 200%, and still they do have a functioning economy. I mean, why worry when the US's debt to GDP is close to a little bit higher than 100%? I mean, just what is really the counter-argument against that?
Yeah, I think you need some fiscal space for the next emergency, and if your deficit ratio is already very high, that's quite difficult. I think an additional reason to worry is the link between the trade deficit and the external imbalances, or the fiscal deficit and the trade deficit. Because when you run a really large fiscal deficit, you need to borrow from the rest of the world unless your private sector is making up the difference, and ours is not, right? So we're borrowing a lot from the rest of the world. The flip side of that is, of course, the trade deficit. So if you've got leadership that views the trade deficit itself as a policy goal, which we do at present, right, the only way to address that is through the fiscal deficit. These attempts to lash out to the trading partners aren't going to work out, right? So I think in this particular context, that's an additional risk associated with high U.S. deficits, is the external imbalances aren't going to go away, and the leadership is going to blame other countries rather than taking responsibility for it, because the one lever that we do have is fiscal policy, but we can't control.
And that is the contrast.
savings
Everything you
abroad.
described is the contrast with Japan. I mean, it was because Japan had the domestic financing. And,
Yeah, we have to borrow from the rest of the world.
And by the way, the fact that in the past people said, why worry about debt? And they point to Japan and say debt to GDP is over 200%, so why do we worry at all? I think the bottom line is that the cost of borrowing is much higher right now in the US. And if you look at the cost of debt servicing in the US, that used to be more like 2% of GDP before the pandemic. We're now at 4.5% of GDP. In the case of Japan, they still have extremely low rates at which they're borrowing from the markets and so on. So it's, I think the question to ask is, when you have 4.5% of GDP that's basically going for debt servicing, then obviously your fiscal deficits are going to be continue to be quite large. And I mean, unless you can get growth up quite a bit, which, again, I'd like to be optimistic that policies can get growth up much faster, then yes, then that helps bring it down. But I think it's the environment that's changed now is the relationship between interest rates and growth. Yep. It used to be much more favorable before, it's less favorable now.
The historian...
In fact, you see it quite a bit in Africa where we had stronger growth before, pre-COVID. But now growth has slowed down. The interest rate and the premium is higher, so that R minus G gap has widened. And it's a real problem. Yeah. That's how we're accumulating more debt via that channel, apart from the primary deficit. So basically being growth friendly is key. So the point from London Stock Exchange colleague about being growth friendly is very critical everywhere, even for Africa. But from some parts of Africa, an issue that is real is climate shocks. Climate shocks. You see that in Zimbabwe, Malawi, everywhere. And a window of opportunity is opened again working with the private sector, where we are now able to buy sovereign insurance from quasi-private institutions. And we're able then to bridge the gap on the fiscal front from that to deal with social protection programs and so forth. So sovereign insurance will play a very critical role going forward to cover some of the fiscal challenges.
There have been proposals along those lines, but then that would bring us into a whole other range of discussion. But
it's already happening.
Yeah, no, that's true. Yeah. David Schwimmer, I just wanted to come back to you just briefly on this question that's raised about the Africa and the challenges. I mean, yes, you want to attract the private sector, but it's hard to argue. I mean, and perhaps we have seen some frontier finance and liquidity coming into the sub-Saharan Africa and elsewhere in the last year or so, but it is the environments in which you tend to see that money flow are in the low-yield environments that we've had in the past. You don't tend to see it when yields are going up and when there's more competition for finance. So I guess that's the kind of brutal reality, whatever you say about being growth-friendly. And
I agree with you. I think it's more challenging now. If we had addressed or tried to address this opportunity when rates were lower, it would have been much easier. I think that the fact that rates are going up is going to make this a much more challenging situation, and it may actually become, if you look at the US government bond markets, rates going up may become a forcing function that really require, in more of a crisis kind of situation, resolution of this issue and more dramatic activity taking place. So again, no argument with you. I think we're in a more challenging situation than we were during the many years of effectively free money.
Basically, we've run out of time, but Gita Gopinath, I guess there was a senior member of your institution who told me recently that they quite firmly expected there to be a major financial challenge for multiple countries coming out of the current set of imbalances and the potential and the crisis in the next few years and potentially in the next year. Do you share that concern that just the mix of factors that we have now, the yields, the debt, the trajectory for policy in the US and elsewhere, just feels that the IMF is going to be facing another crisis of some form?
Well, I mean, if you look at the fundamentals, a combination of, as you said, high debt, low growth, high interest rates is not an easy one to tackle. And there are many other things that can change in the near future. So these are challenging times. But I just want to pause and just remember that the last few years, we went through some really tough times with the pandemic, with the energy crisis, with the Fed raising interest rates by 450 basis points. And you know, a typical IMF meeting would have been, this is going to be a lot of trouble. This is going to create a lot of problems. And it hasn't. So countries have built resilience. There, you know, we will certainly absolutely see countries that will have trouble. But I think we should maybe end, you know, if I want to end on an optimistic note, I would end by saying that many countries, emerging and developing countries, have actually built up a lot of resilience. They're not borrowing as much in foreign currency. They have much more sounder monetary policy frameworks. And you know, they are trying to do what they can on the fiscal front. But again, I want to make the point that, you know, doubling down on the structural reform agenda of the kind that doesn't involve the government doing a lot of industrial policy and so on, but basically fixing all of the long-standing issues in terms of ease doing business, in terms of being able to encourage innovation, deepening your domestic financial markets, education, I think is super important. All of that is what will be extremely valuable to get out of this problem durably.
Okay, well, thank you very much. We have covered a lot of ground, but thank you to all the speakers and thank you to you for joining the session.